Hey, Puppy Trades! I did it! I solved finance, and this is my capstone thesis. I switched from being a finance major to a supply chain major late in my college career, so I never got to do my finance capstone thesis, but I'm going to do it now. I've studied finance for so long, and this isn't financial advice, obviously, but I think I really did it. I figured out finance to the point where the only risk of this strategy is that one of the funds closes down. Like they genuinely just say, we're not using this fund anymore. We're going to close it down. We're going to liquidate the fund. That's it. And even then, I just get the money that I have invested in that fund back. This is incredible. It allows for infinite stacking of the NASDAQ 100, the best stocks in the NASDAQ. It allows for infinite stacking of that. It allows for someone wanting the stock market to crash and wanting the stock market to go up and wanting the stock market to go sideways at the same time. All three outcomes are beneficial, and the crash scenario is most beneficial to this portfolio. It's really amazing how to get a delta neutral 10% return that compounds forever. This is safer than bonds. It's safer than treasury bonds. It's the holy grail. Presented by Puppy Trades. Warning, this is for entertainment purposes only and not investment advice. I am not a certified financial advisor. So I've been trying to get a delta neutral short strangle style trade that compounds forever for years. This is from February 1st, 2021. You can see my work. Um, this is just a picture of what I did for years, putting stocks together, and designing straddles and strangles and trying to build a consistent formula. The problem with trading is once you're done with one successful trade, you got to do the whole shebang over again. You got to rescreen the stocks. You got to analyze the sector fundamentally. You got to recount the sector from Elliott Wave. This is figuring out finance and being done with it. Really being done with it to the point where I feel like I could start a completely new career and know exactly where my money is going and being very happy about it. So my multi-year quest to find a short strangle without having to sell options directly, no counterparty risk. Or sorry, there is counterparty risk, but um, there's no risk of getting assigned. There's no risk of a margin call with this strategy. So every investor's dream is to find a delta neutral or risk-free return that beats bonds. 10% return is extremely high in a low-risk context. Typical risk-free assets like U.S. Treasuries pay 4 to 5% at best, and even those have risk. If someone genuinely had a delta neutral market independent strategy producing 10% annually, that's twice the risk-free return without bearing market swings. This is like discovering a machine that prints money consistently, extraordinarily rare. This is like discovering a machine that prints money consistently. It's extraordinarily rare. Sustainability equals compounding forever. If the strategy is repeatable and reliable, you can reinvest the gains continuously. Each year you earn 10%. You can roll it back in, letting compounding multiply your capital exponentially. So the math equals that A equals P times 1 plus R to the power of T, where P is principal, R is 10%, and T is years. Over time, this grows faster than almost any other low risk strategy. 10% risk free is the holy grail. Delta neutral or risk free means no market dependency. You're not betting on stocks, bonds, or crypto going up or down. Your capital isn't exposed to crashes or rallies. It actually wants a crash. You can sleep at night without worrying about a 50% drawdown. This strategy wants a 50% drawdown because the dividends from one fund will explode higher and allow for reinvestment in the other fund at a steep, steep discount. The best stocks in the world. Beating bonds is real alpha. Current U.S. Treasury yields 4 to 5%. If you find a delta neutral strategy paying 10%, that's double the risk free return with almost no exposure. That return is essentially free money relative to safe alternatives. Compounding forever. Delta neutral and consistent yield equal infinite automatic wealth growth. You don't have to predict markets. You can just invest. This is the cool thing. I don't have to predict the market. I can just invest in this. I genuinely don't care what the market is doing. I don't even need to check. Over decades, even small capital grows exponentially. So in a way, this can already be done. You can get a 10% return with a modest dividend yield from CLOZ. That's a collateralized loan obligation ETF. But even collateralized loan obligations, they have risk very similar to bonds. And this ETF, I believe, is a triple B rating for the bonds. And they're not bonds, technically, they're collateralized loan obligations, which are different than bonds. But this can already be done with a CLO ETF called CLOZ. If you believe that CLOs have no risk, which they do, so CLOs actually are going to have more risk than this strategy. This means that this is probably safer than investing in treasury bonds. This is genuinely probably safer than investing in treasury bonds. Of course, if the treasury bond market goes kaplat, this goes kaplat too. Let's just look at the math, the facts, man, just the facts. If you invested in ONEQ on the day of YQQQ's inception, you invested $10,000. It turned into $13,633. ONEQ is the Fidelity NASDAQ Composite Index ETF. YQQQ is the YieldMax Short NASDAQ 100 Option Income Strategy ETF. We'll get more into these ETFs. This ETF shorts the NASDAQ 100. This ETF longs the NASDAQ Composite Index ETF. Okay, so that's really important to understand. They're slightly different. One's the NASDAQ Composite Index ETF. The other one is the Short NQ Option Income Strategy ETF. If you invested $10,000 in YQQQ on the exact same day, your $10,000 turned into $8,376. So investing in the YQQQ and ONEQ together, which was completely delta neutral, one side long the NASDAQ Composite, the other side shorted the NASDAQ 100, achieved a 10.045% return. That is calculated. Given this, the gain was $2,009. $20,000 gained $2,009 without any risk at all. Any risk at all. I mean, that's pretty crazy. The gain was $2,009 divided by the original investment, which was $20,000 times 100, 10.045. If you averaged into these ETFs, the results are very, very similar. They're actually better. The annualized return for ONEQ since inception of YQQQ has been 31.08%. The annualized return for YQQQ, when you blindly average into it, has been negative 14. 31 minus 14 is 17. So 31 minus 14 is 17. This suggests we could actually be looking at a 17% annualized return. And these calculations were made while the NASDAQ was off a high, while the NASDAQ is currently pulling back. It would actually most likely be much higher total annualized returns if we were at an all-time high. So this is incredible. Someone can average into ONEQ, get all the exposure of the NASDAQ, and they can fully hedge it with YQQQ, and they can get a fully hedged portfolio that's generating 10 to possibly 17% a year and doing incredibly well without any downside risk. You actually want the market to go down, because then YQQQ's dividends will go up and you can reinvest those dividends into the pair at lower prices for ONEQ. So this is absolutely incredible. The perma investing into 50% YQQQ and 50% ONEQ thesis. It allows for infinite exposure to the NASDAQ. This shouldn't say 100. This should say infinite exposure to the NASDAQ Composite Index, which has the same top holdings and allocations as the NASDAQ 100. So just in the big picture, the top holdings are the exact same. So what's moving these indexes are the exact same. It allows for infinite exposure to the NASDAQ Composite Index, which has the same top holdings and allocations as the NASDAQ 100. When the market crashes, YQQQ dividends explode higher and allow for more reinvesting at cheaper share prices of ONEQ, which fuels future bull market returns and dividend growth years down the line. Eventually, these NASDAQ companies are going to initiate or grow dividends, unlike pairing winter with IBIT, which is an ETF that's short strategy, and pairing it with Bitcoin ETF IBIT. The correlation is perfect in this scenario, and the convexity asset, that means the asset that is driving the portfolio gains higher during bull markets, cannot hit zero. Bitcoin can go to zero. ONEQ cannot. All those companies cannot go to zero. It's the ultimate flywheel strategy, a fully hedged portfolio that has a chance for risk-free infinite compounding. This is the holy grail of finance. So these are the two funds. Someone would be accumulating an ETF that holds Apple, Microsoft, Nvda, Amazon, Broadcom, Google, Tesla, and Meta forever, and they'd be hedging with an ETF that has a 20% dividend yield and pays that weekly. So it's absolutely incredible. If this gets 30 likes, we'll talk about how this portfolio can get an even higher dividend yield that is paid more frequently. And we'll talk about the ways to make this portfolio even sexier and have even more upside. So let's get 30 likes, guys. Come on.